Welcome to the deep dive. Today we're cutting through the noise, really getting past the general advice. We're drilling down into the Austin real estate market, specifically the data as of Thursday, July 10th, 2025. This isn't your typical housing update. We're using the latest Team Price Daily Real Estate Briefing for a sharp analytical look, really trying to arm you, agents, investors, informed buyers, with the detailed insights for your next strategy session.
Exactly. We're going to unpack the key metrics, figure out where we are in the market cycle right now, and importantly, identify where buyers might have some leverage and what risks sellers are facing. The goal is really to pull out the most critical bits of knowledge from the Austin MLS data and the recent reports, going beyond just the headlines.
All right, sounds good. So with that perspective, let's dig into the foundation here. Let's talk inventory. What's actually out there?
Yeah.
Okay, let's jump straight into the numbers. They really tell a story. Current active residential listings. 17,713. Now, that is down slightly, about 363, from that peak on June 27th. But still, historically, that's a very high level for Austin, right?
Oh, absolutely. It's elevated. And that high inventory, it's more than just a number. It really signals a power shift. When supply runs this high, it puts pressure on sellers.
And we're seeing that in pricing already.
Definitely. A significant 57.7% of all active listings, they've had at least one price drop. Think about that. Over half the market has had to adjust downwards.
Wow.
Yeah. It tells you the pricing climate is, very buyer favorable. Sellers are adapting to longer days on market. They're realizing their initial pricing might have been, let's say, a bit optimistic for this market. And you see it even more in places like Georgetown, Round Rock, Pflugerville, over 60% price cuts there.
So that raises the question for sellers, are you priced for today? And for buyers, it sounds like negotiation room.
Exactly. Patience and a strong negotiating position are key for buyers right now.
Okay, so inventory's high, prices are dropping. What about the buyers themselves? Are they actually engaging? Let's look at the activity index. What's that showing us?
Well, the activity index, which tracks buyer interest, clicks, saves, that sort of thing, it's still eroding. It's down to 19.6%. That's a pretty big drop, 15% year over year from 2024's 23%, which was already kind of muted.
So buyer engagement is definitely cooling.
It is, even with all this inventory. And that ties directly into the months of inventory, the MOI. It's expanded now to 6.28 months.
6.28, okay.
Yeah, up 17.7% from 5.34 last July. Think about that. If nothing new came on the market, it would take over half a year to sell everything currently listed.
That's a lot of breathing room for buyers. Less pressure.
Definitely less pressure, more time, more negotiating power, things you couldn't imagine just a couple years back. And it's not just a quick surge in listings causing this. It's a persistent mismatch between supply and demand that's been building for, several quarters now.
You mentioned that this divergence, new listings versus homes actually going under contract, that seems critical. Is this just normalization or something more?
That's the key question. And while some normalization is expected, the size of this gap suggests something more structural is at play. Look, year to date, new listings are at 30,756. Okay, that's down slightly, 2.5% from 24. But it's still 16.5% above the 25-year average. So plenty of supply hitting the market.
Right. You'd expect a healthy market to absorb that.
You would. But pending listings homes going under contract year to date are only at 23,810. That's down almost 15% year over year. And it's nearly 7% below the long-term average.
Okay, so supply is above average, but contracts are below average. That is a disconnect.
It's a clear signal. It points to affordability issues, economic uncertainty weighing on people. We're seeing headwinds for move-up buyers. And investors have definitely pulled back. They were a big demand driver before. The ratios really show it. The monthly new listing to pending ratio is just 0.52. Year to date, it's 0.67.
And the historical average is
0.81 over 25 years. So we're well below that. It shows this inefficiency inventory is building up much faster than buyers are taking it off the market. It creates a bottleneck.
All right, let's get to the bottom line then. Pricing. Everyone wants to know about prices. The data still shows a pretty significant correction from the peak, right?
Absolutely. It's sustained. The average sold price is now $593,277. That's a 13% drop from the May 2022 peak of $681,939. So almost $90,000 off on average.
And the median price, that often tells a clearer story for the typical home.
It does, and it's fared even worse. The median is down 19.09% from its peak. It peaked at $550,000. Now it's $445,000.
Wow, that's a $105,000 drop in the median.
It's a huge number, and it really shows how much the entry-level and mid-tier parts of the market have softened. That's where most transactions happen. If you compare today's median to 36 months ago, it's down 13.59%. Basically, most of that rapid post-COVID appreciation gone.
That's a tough reality for anyone who bought near the peak.
It is. It directly impacts equity and what sellers can realistically expect.
Okay, this is where it gets really interesting, maybe a bit sobering. Given these drops, what's the outlook for recovery? How long until median prices get back to that peak?
That's the big question. And using the historical data, Austin's 25-year compound annual appreciation rate is about 4.934%. Based on that sustained historical rate, we estimate it would take about 55 months.
55 months, so that's almost 5 years.
Until roughly January 2030 to get back to that median peak of around $548,000. Now, this isn't a doom and gloom forecast. It's just reflecting a necessary market realignment. That crazy growth in 2022 wasn't sustainable. The market's re-anchoring to historical trends.
So for buyers, it suggests maybe patience, a longer window where prices aren't skyrocketing.
Exactly. More about strategic buying than just riding rapid appreciation. But for sellers still thinking about those peak prices, it's a recalibration. The market isn't going to quickly bail them out. Realistic pricing is absolutely crucial.
You mentioned earlier this bifurcation, different price points behaving differently. Can you break that down? What's happening at the high end versus the lower end?
Yeah, the data really shows a clear split. Homes in the bottom 25th percentile, they saw prices drop about 5%, both overall price and price per square foot. That's your most price-sensitive segment, hit hardest by rates and affordability.
Okay. And the top end?
Much more resilient, at least on paper. The top 25th percentile saw only about a Montgomery 0.4% decline in price and less than 1% drop in price per square foot. So better price stability there. But, and this is important, demand is still thin at the high end.
Why is that?
Still rate sensitivity, even for affluent buyers, and maybe fewer all-cash deals than you might expect in luxury. So for a luxury buyer, while prices haven't crashed, your negotiating power is probably stronger than you think, especially with cash or less rate sensitivity. You might be able to dictate terms more.
Interesting. And this split isn't just by price point, but geographically, too.
Right. Within the Austin metro, we see 13 cities with median prices actually up year over year, but 17 cities are still down. It really is a market of micro markets right now.
Okay, shifting from prices to sort of the market mechanics. How efficiently is everything working? Let's talk absorption rate and then that market flow score.
Good way to think about it. The absorption rate, the sold to active ratio, how fast homes get absorbed, it's at 17.68%. Austin's historical average is almost 32%, so 17.68% is significantly lower.
We're not quite at super low levels, like below 10%.
Not yet. But the trend is clearly moving towards a buyer's market. Supply is plentiful, things are moving slower, especially in certain zip codes or for homes needing updates or not priced aggressively. Now, the market flow score, the MFS, think of that as the market's pulse. How freely are homes moving? It's on a 0 to 10 scale.
And where are we now?
We're at 5.06. The long-term average is 6.61. So a score in the fives puts us firmly in sluggish territory.
So if it were an 8, homes flying off the shelves.
At 5. At 5, homes are sitting. Sellers need to be more strategic. Maybe offer concessions, closing costs, be more flexible on terms. Things unthinkable a couple years ago. A low MFS means longer marketing times, stale listings, more pressure on sellers to make deals happen.
Okay, given all that, let's look at the actual number of sales. You said 2,745 homes sold for the month. How does the year-to-date volume look?
Year-to-date, we've seen 17,824 properties sold in Austin. Now, that is down 5.1% from last year. So yes, a slowdown from 2024. But here's the interesting nuance. It's still 7.3% above the long-term average number of sales.
Okay, so not a collapse in activity. More like a plateau.
Exactly. That's a good way to put it. Transactions haven't dried up. It's just shifted from that frantic pace to something more measured. Still active, just different. We're selling fewer homes than last year, but still more than the historical average.
Got it. But you mentioned adjusting for growth, population growth, and critically the number of realtors. That paints a different picture, doesn't it?
It really does. And this is key for agents and investors listening. When you factor in Austin's growth, the market looks stretched thin. Year-to-date sales per 100,000 residents, down 7.3%, and now almost 21% below the long-term average on a per capita basis.
Okay. And per realtor.
Even more stark. Cumulative sales per 1,000 realtors, dipped slightly year over year, but now almost 25% below the historical average. What that means practically is more competition among agents for fewer deals per agent.
A less efficient market, especially for sellers trying to get attention.
Precisely. More hands reaching for a smaller piece of the pie, relatively speaking. For agents, it means you really need to hustle, provide exceptional service. For sellers, your marketing and presentation have to be top-notch to stand out.
Okay, so let's summarize this deep dive. As of July 10, 2025, the Austin market is still clearly dealing with imbalance. We've got high inventory, lots of price cuts, buyer demand pulling back, and affordability is still a major hurdle.
That's right. And while the big price correction seems to have mostly stabilized, the road back looks slow, long, and definitely uneven across different segments. For buyers who are prepared, this environment gives you real negotiating leverage, more choice, less frantic competition. It's a window for strategic buying. For sellers, realism on price, meticulous presentation, and a sharp strategy are non-negotiable for success in this market. You really can't just list it and wait anymore.
Yeah, it feels like the takeaway is the market isn't just waiting to bounce back to the old highs. It's actively recalibrating to a new normal. So the question for you listening is, how are you going to adapt your strategy to this new reality using these insights? And remember, for all the supporting charts, the visuals that really show these trends, and the complete Team Price Daily Real Estate Briefing, just visit teamprice.com. We update and publish this detailed market info on teamprice.com every single day, so you can always be informed and stay ahead. That's teamprice.com.